So today's discussion is very reflective of the constant struggles that I face after having moved to CredAble, where every Monday morning we have a catch up where I am pushing for compliance and business is looking to grow. And we have this 15 minutes of tiff in the morning where we try and find the sweet spot in between ensuring that we adhere to the requirements of the RBI, both in letter and spirit, and the obvious sort of continued need to grow our business in a manner that is acceptable to all our stakeholders. So to kick this off, and it's a tightrope exercise that each of us do, and I'm personally very excited to hear the thoughts of the thought leaders on this panel on how they are navigating these challenges in their everyday life, and to hear their views and thoughts on certain aspects of ensuring compliance with the RBI diktat versus the constant desire to grow. So I'll start with Aiswarya. Before we sort of look forward to this, uh, in your organization and for you personally, how do you protect the company's financial interests and weigh consumer behavior against this ever-evolving regulatory landscape? Because as you and me know, the RBI likes to surprise us right before long weekends on most Monday mornings by completely overhauling how they look at certain regulations. So for you, how do you navigate this landscape and push your organization towards heightened levels of compliance?
Thank you for the challenging question right off the start. But having said that, the first immediate reaction, it's a complete tightrope. You are right. Our everyday morning catch-ups is on what the RBI has said next and what's going to come, and how do we balance between having the right regulatory framework and having that business potential to do business as well, because as a company we all have to do business. Now, coming specifically to your question on how we do it, so my company is Kinara Capital. It's an NBFC focused on last mile distribution at the feet on street level, which means we need to go and underwrite customers who may have access to fintech or may not have access to fintech, and how do we sort of trade the balance between what RBI has regulatorily given us vis-a-vis doing business. I think of it in three sort of terms. I would say RBI, being the watchdog, need to do things what they're doing currently, although we at the business end of things feel really confused and challenged in trying to comply with all of them. But in my mind, I've sort of slotted them into three different characters. One being enabling, second being the sort of transparent behavior which they try to promote, and the third being in terms of vigilance, right? So in terms of enabling, we've seen a lot of changes happening here, like their latest circular on credit through UPI. That is enabling. Come on. If you look at other geographies, even Europe, for example, the kind of phenomenal growth what this segment has seen here in India is very, very different and very, very advanced than some of the most advanced countries out there, right? So this is a great enabler. Second, on digital lending guidelines, there has been a lot of confusion, but having said that, RBI has started taking stance on what they think about digital lending, and they are enabling it to try and figure out what are the guardrails within which this segment needs to operate in. So that's a great starting point, I would say. And the third, co-lending frameworks, right? So which is very front and center to doing business. They realize it. At the end of the day, banks and NBFCs need to sort of work together, and hence how as watchdogs they can enable this environment, and they've come out with rules around this. The second bit is around transparency itself, on both the customer side and the business side. For example, how do I protect the financial stability of Kinara is a question you asked me. So in terms of how do I ensure the customers I'm lending to are proper, fit, and are coming from the right sources of money. Like the latest on AML and the FATF regulations, etc., are very now closely aligned with the RBI rules on KYC as well. So I get protected. I don't do it because RBI is asking me to do. Of course, I need to be sure where these sources are coming from. But having said that, on the other side of the table, the customer needs to be aware of what he's getting into. So the rules around key fact statements and what the customer needs to know before he gets the loan are again front and center of how RBI has sort of thought through it. And the third bit, which I said, was the vigilant, right? So being the vigilance, of course, they'll have to bring in regulations so that they monitor all of us so that we are in sync. And the scale-based regulations, the new NPA norms, and all of these pieces are, again, creating, in my opinion, a very cohesive ecosystem. Of course, we have those catch-ups and understandings as to what next RBI is going to come up with, but as an ecosystem player, to trade the balance between financial business opportunities and being responsible lending in this ecosystem with customer protection, I think RBI is front and center in terms of the real watchdog they are out to be.
Thank you, Aishwarya. I think that's a very fair point, right? That if you look at what the RBI diktat is intended to cover, it's effectively disclosure and transparency from a customer's perspective. That as long as the customer is aware of the risks that they are underwriting in being a part of the financial ecosystem, as long as that is adequately disclosed in a manner that the RBI is comfortable with to the customers, I don't see the RBI having any sort of larger concerns. But just moving to Kanika now and drilling slightly deeper into this topic, right? We've seen in the last few months, and I think this has been a trend since last June, where the RBI has continuously evolved their views on KYC, on fair practices, and other sort of good to have diktats, which are now binding on financial institutions who are participants to this ecosystem. So how do you view that, and how do you ensure that you're ahead of the curve in complying with these?
Right. So one thing you very well said, that RBI is getting a lot more active since last sometimes, or maybe since last June, and that is something I would say is very encouraging, because if you see before that there used to be a lot of confusion in terms of interpreting that what is it that is coming as letter, what is the spirit of it, and many a times there would be a lot of for example, let's take the Aadhar KYC. We know how long it took to actually come up to a fact that this is how we can do KYC or not KYC. Right? So that ways RBI is a lot more active. But having said that, I would say that there's a long road that RBI needs to cover, because when it comes to ground, the clarity is something which I think most of the organizations spend time on, that this is what the letter is saying, but is the spirit this or spirit that? So that's one. The second is also that if you look at carefully, if you keep one thing in mind, that what is your organization's best interest and what is your customer's best interest, then essentially you would know what the spirit is saying. Right. So then saying that I do not understand, it means that, because usually you would have that conversation if you are having the discussions whether RBI means X or whether RBI means Y. I think it's usually very clear. So that's point two. And point number three is also that the clarity that RBI is bringing in terms of, for example, what your DLAs should be in lending, if I speak, right? So what your DLAs should be doing, what are the norms under which they are covered. So those clarity, that clarity is also very important, and it has come to a large extent. It helps you because as a NBFC, you tie up with multiple vendors. And while you are trying to safeguard the interest, you are trying to have all the data protection and everything, what you are unsure of is what your vendors at the other end are doing. So having them covered under the regulation is definitely gives you a lot more comfort. And yes, I look forward that how RBI is coming up with the next regulations, because everybody's eyes every day is on that piece.
Like, I think there's a very key point that you touched upon there, right? That the RBI is now looking to regulate even ecosystem participants because they cannot function without the support of financial institutions like yours or mine, right? So, the question that at least jurisprudentially I struggle with is it right for a regulator who has no role in regulating these ecosystem participants to force that regulation through the regulated entities? That at the end of the day, say if I am a Aadhar verification tool or if I am a credit assessment tool, should I also then be under the RBI lens, or am I supposed to be independently regulated? Now, currently, the stance that the RBI has taken over the last 12 to 18 months is that we do want to regulate you, but we are unsure how. So, for now, we'll regulate you akin to the regulated entity because of whom you are able to survive or you're growing your business. Now, moving to Roopesh, now, in this light, where do you see this regulatory framework headed over the next 3 to 5 years? Do you see this regulatory landscape evolving? Do you see the RBI letting go of some of the controls that they've mandated, or do you see the RBI allowing this to continue to the point where it becomes scalable enough for the RBI to be worried about it?
See, while I'm not a clairvoyant, I can't be crystal grazing and saying what happens 3 years or 5 years hence. One, because I'm not a clairvoyant. Second is because the speed of change that is happening around us. Just go back 5-10 years ago. None of us had heard about UPI. None of us had heard about Aadhar. None of us had heard about Jandhan. All we had heard about these schemes which the government was thinking. But today they are the reality. Go back 2 decades ago, most of us did not even have a mobile phone, right? Today we can't even think of a moment where we don't have a mobile phone. None of us thought about Aadhar KYC, which you just spoke about. Today, most of us don't see a future or a present which does not have Aadhar KYC. So one, change is happening much fast, right? Hats off to the regulator, and being part of many of the interactions with the regulator has been, I think, at the forefront of adapting to that change. It has not got stuck that I am the regulator, I am the arbitrator, I decide the rules, and I will choose my time of implementation. No, it has been ready to accept change. Innovation hub that RBI has created is a step inwards that. The brown box or sandbox testings that they are giving to most of us is also a symbol of that. So the regulator has not only been a level playing field for us, it is also ensuring that the end consumer is protected. See, look at it this way. All of us today here, commercial, non-commercial entities, for profit, not for profit, we are here because of the consumer, right? It is not because we had a great idea, everyone has to buy it. We have an idea which has a need in the market. Now, how do we ensure that that honest or that pious thought which we started with, that we were doing it for the consumer, does not become a commercial thing after some time, right? Because greed can take over everything very fast. So who is going to be the third party interpreter? Who is going to be the level playing field creator to ensure that the end consumer for whom everything was created is still front and center of everything? It has been the regulator, whether it is RBI, whether it is SEBI, or when you look at IRDAI, all of them, the preamble or the basic principle that they follow is, how does the consumer see it? Because most of the time what happens is, what a good idea starts off with quickly deteriorates into a money making scheme. And not by, it's not as if it is just because the person has a bad intent. That is by design, because greed takes over human actions. So regulator helps ensure controlling that. While you make profits, most of us are profit making company, but the profit should have a sense. It should have a purpose. It should have a plowback mechanism back. On the second point, as to how the regulator sees changes. Now, change is not just happening in India. The changes which we spoke about, Aadhar, UPI, these are all actually world-leading changes. The best of countries, and I think my fellow colleague also mentioned, Europe doesn't have it. Why even US doesn't have it? The best of the economy whom we think is the most advanced has no unified system to identify every customer, right? While you may say social security number and all, it is not ever pervasive, right? There are still leakages which happen. US has the largest number of check dolmens which happen. They pay out by checks. They still have a large cash economy. BNPL, which is coming up fast, that also happens in India, right? How do you ensure that the customer sitting in Malabar Hill to a customer sitting in the Machimar Nagar, which is just in front of Malabar Hill, to a customer sitting in Machilipatnam, to a customer in Muzaffarpur, all of them see the same use case, see the same benefit, and understand what is being given to them? That is something which the regulator does it through their circulars. My fellow colleague also mentioned that we fear every day a new circular coming through. Now that's a reality. Today, circulars keep on coming in NBFC system also. But look at the circulars, how RBI drafts it. Most of them are guidelines. They are like the sandbox, the play box within which they want us kids to play in within the rules framework. It's for us to find out what is the innovation happening in that. It's for us to test the boundaries, come out with innovative solutions which actually serves an end use case, is beneficial for the customer, equitably beneficial for the company. And ecosystem players, to the point which you mentioned, are part of that ecosystem. They're not outside it. We should not treat them as holier than thou. They only know how solutions have to be developed. Well and good, they know what solutions have to be developed, but what is the end purpose of that solution? How secure it is? Is it equitable? Is it demographically challenging for someone? Is it exclusive for someone? Some of our challenges are also because some solutions are not equitable for everyone. Some of them exclude certain sections of society, knowingly, unknowingly. So regulator helps us in bringing that sanity. I keep on telling my teams that if you think the cost of compliance is high, just try to be non-compliant and you will know what the cost means.
I think you've hit the nail on the head, right? And I go back to the G20, where what we as a nation demonstrated to the world was a best-in-class public digital infrastructure. Now, whether we like it or not, effectively that has been funded and built by the government. At the sort of aegis of the RBI, through the NPCI. Now, given that all of us here are beneficiaries of that system, we also have an equal duty to contribute to it. So when you think of things like a centralized repository for KYC or CKYC as the RBI is now looking at it. Now, these were ideas which were always present in the regulations, where the RBI allowed a regulated entity to borrow the KYC from another regulated entity. But because of innovation, they have now managed to formalize that in a certain manner. Similarly, and I believe this is a minority opinion, but I do think that the pandemic has been a catalyst to this change, where digital disruption has surpassed what we could have seen in perhaps 2 decades in 2 years. Now, what that has led to is a lot of mushrooming of smaller players. And Mr. Tripathi, I'll now come to you. That do you believe that because of this increased compliance requirement, the RBI has set the gate or the entry barrier so high that smaller participants or newer NBFCs are now having challenges to comply because the compliance cost and effort is too high? Or is that still necessary to ensure that the entire system continues to move in the right direction?
Thank you. You see, all the regulated entity or any entity business, they are exposed to various regulators, RBI, SEBI, IRDA, Income Tax Department, GST, Company Law, ESIC, Labor Department. I think you are exposed to some tough regulator, some ordinary regulator. So as he mentioned, any non-compliance is going to cost you more dearly. Whether we want to survive or we want to extinguish, that is the choice. Now coming to the Reserve Bank of India, up to 1,000 crore rupees company, that is those who are base layer, for them the RBI has given the light touch regulation. But the companies which are 1,000 crore and above, The Reserve Bank of India has put that you have to have a chief compliance officer from 1st October 2023. This has been mandatory. The purpose is that they gave the glide path. It is not that none of us will be managing compliance. We have been managing compliance, but there was head of departments were doing in tits bits, and one non-compliance was getting penalty on the company, and the reputational risk. The Reserve Bank of India want, as the financial system and the entire ecosystem is growing fast, the country's economy is growing fast, you need to move, you drive the vehicle at 100 kilometers, but keep your leg on the accelerator and brake. You should not move in a very different direction so that you can meet with an accident. The whole idea is that small NBFCs might feel that cost has gone up. But if you closely go to guidelines, the Reserve Bank said that there should not be double hatting. That means that he should not have a business functions and compliance functions. So if non-business function you are giving some to compliance officer, you can manage the cost depending when your business grows. Similarly, chief risk officer. They made mandatory that 5,000 crore company should have a chief risk officer. It is required because the way most of the companies, because of the revenue generation, because of profit maximization, they go berserk in different approach. It is not that everything is hanky-dory. You keep on seeing that there are problems coming. That's why digital lending regulation has come. Why FLDG regulation has come. It looks very nice that I am giving first class guarantee. What is the problem to RBI? But tomorrow, if you guarantee of 1,000 crore rupees and your net worth is 5 crore rupees, will you able to honor the guarantee? The whole idea is that the RBI is concerned with the stability of financial system, the consumer protection, and more importantly, there has to be continuous innovation, which my friend has just told. So RBI has to treat path between the innovation and the regulation. And I tell you, Reserve Bank of India has a committee, a regulatory oversight committee that keep on suggesting. Last 2 years back, RBI appointed the committee of bankers, fintech players, and the practitioner to advise the regulatory, that regulation authority, evaluation authority, that what regulation are redundant, what can be removed, which does not have too much of impact but too much of cost of compliances. RBI is every time alive that the cost of compliance should not go up. But at the same time, just to save your cost, you cannot blindly play in the market because your one act is impacting the entire financial system. That is the what Reserve Bank of India role is there. RBI is completely aware that compliance, risk management has to happen, and they always try to keep path, whether the regulation should be pushed on or should be pushed off. But at the same time, they manage their regulation along with the fintech innovation. But fintech innovation can go any direction. Everything is not, I think somebody mentioned that every entity is not regulated. The act of that entity may fall upon the regulated entity. If I am tying up with any fintech company for any verification, if something goes wrong, I am responsible because that is an outsourced agency for us. So friend, compliance functions are putting some higher cost. We all are getting worried about that. But I tell you, once a regulation comes, after some time we feel that this regulation is helpful for doing business. After ILFS and DHFL and Reliance Home crisis, in 5 years, you have seen plethora of regulation, and the most important was liquidity management. That compliance was mandatory. Today, in last 5 years, how much growth we have seen, but not a single entity has failed. The regulation always gives strength to the organization, and most of the regulations are customer focused. I think he mentioned the customer centricity. RBI is very clear. If you are charging very high pricing to the customer, that's why penal interest and penal charges were changed. So all these regulations you will see, these takes care of the person for whom you are existing. If your customer is not there, how you will do? As Steve Jobs said once, which Shaktikant Das also quoted in one of his lecture, that you got to see that customer experience is fine and other things work should in reverse direction. So regulation, compliances, these are very important. Cost of compliance If you are 1,000 crore rupees company, 40 crore rupees profit is there, you can afford 30, 40 lakh, 1 lakh crore, depending on your size of company, the compliance officer. And then one person will relieve the entire company from the headache of compliances.
Thank you, sir. I think I'll take away one key point from that at the end of the day, compliance is a headache. Whether we like it or not, whether we are looking at this as human beings or participants of a financial ecosystem, we want to comply with what we believe is the correct ethical standard. No one else should dictate it to us. Now, sir, I'll come to Sakya. And on that point, so Roopesh.
If I may say something, my team has said that to me, compliance is a headache, regulation is a headache. So I tell them, if you have a head and you get a headache, that means your head is functioning, right? It's also important that sometimes you should get the headache. You'll remember that head has to be taken care of. Headache is a symptom that something is not functioning what it's supposed to be. There is no human being in this world who can say, I never had a headache till the time I died. So that headache tells you that that function of that organ has some hindrance. So it is important. You should have headaches. Too many headaches obviously has a different problem and you have to see a doctor. But headache is an important part of being in business. So compliance is required.
That's a fair point, right? That, as you know, and going back to that same thematic point, that if you're a part of the ecosystem, you will be regulated. But because disruption and technology has moved faster than regulation, and one sort of credit that I always give to the RBI for the last 3 to 5 years is that historically the view has always been, if we don't understand it entirely, let's prohibit it. Now they have moved to a softer regulatory approach, that let's first try and understand it. How is it helping the ecosystem at large? How is it beneficial to the customer? And what are the regulatory guardrails that we need to place around this, such that people who are controlling these ecosystems are not able to abuse it? Now, coming to you, Sakya, and when we talk of sort of compliance or regulations or what we believe is spirit, do you believe that there is still room for ethics in trying and looking at new products? So when we think of, say, an AI credit assessment, which is something which is not sort of more than 12 months old. The RBI has not looked at this yet, or at least come out with formal regulations around it. There have been a plethora of discussions. Or when we look at any form of automated process for KYC or loan disbursement, do you believe that ethics here is the sort of first threshold that we need to cross? Or should we only focus on what is the minimum requirement? Am I ticking that box? And then can I move on from there?
Thank you so much for the question. So what I want to talk about is, how do you thrive ethics in the organization? From that perspective, I want to look into two parts. One is what should we do and how should we do it? From a what perspective, it's very clear that as an organization, we need to take care of all the lines of defense, first line of defense, second line of defense, and third line of defense across various junctures. The second part is why and how you should do it. More importantly, how you should do it. So from that perspective, I think there are 4 pillars that you need to think about. The first pillar is, of course, people. That how do I make sure my team is aligned to the ethical goals? My team believes in doing business in an ethical manner. Simple things, you can give trainings to them. So I will actually give you a practical example. Yesterday, I was in Bangalore, as usual, evening traffic, trying to rush back to the airport. And I was rushing my driver, the cab driver. So while he was trying to make it more than 60 kilometers or 80 kilometers, a pop-up came in the application saying that, you are driving very fast. And he turned back to me saying that, sir, I can't do it, because if I do it, I'll be fined 50 rupees. So this is how the nudge of doing business correctly happens. That I was probably guilty asking him to drive very fast, and I was a consumer there, so he was trying to satisfy my needs. But this is the nudge, which again, in the financial services world, I've seen banks where, very small things that, you put brochures, you put in the meeting rooms, put something saying that, cost of non-compliance has hit XYZ bank by this money. If you have done business with gray customers, then this is what has happened, so on and so forth. So instilling that culture with the people, that's the first pillar. The second pillar is about the process. So again, as you highlighted, technology disruptions are happening, but at the same time, it runs through a process. So making sure that process, one part is making efficient process, but at the same time, making the process more ethically tuned is also very important. So that starts when you are developing the SOPs itself, be it the process at a branch level, be it the process at the feet on the street. So this is where you start defining the right way of doing the business. The third pillar is, of course, technology. When I say technology, it's about, and a lot of the panel members spoke about, the regulations now touch basing to the third parties. That is required. So I represent the third party amongst these panelists. So, and we know exactly what is happening from the bank side or NBFCs, and given that we are working in a global phenomenon, so we know what the global banks have also asked us to do. It's not about choice. It's about how proactively we are participating to make sure the business can run by the financial institutions in a proper manner. The fourth part, which is not yet touched upon, is data. That's the fourth pillar. So any AI model, if you have a wrong input, the output is going to be wrong, right? We have seen so many examples in the past. So making sure to collect and manage and attest the correct data for any kind of business in output is going to be extremely critical for the business. And this is something I think NBFCs need to elevate themselves to an extent where they make sure the right usage of data, because this is where all your reporting to the regulators, all your reporting to any other shareholders, we typically, let's say, the shareholders also ask for information. You can always paint a glory picture, but with the correct data.
Point. I think if we look at, and I'm just touching upon the data aspect because that's something which is very close to my heart. We now have an entire overhaul of how we view, process, use, store, manage, and forget any form of personal data. And it's been a tumultuous ride so far, right? Where we had legislations which were passed, rules that were drafted, and then that legislation was dropped in its entirety. We've had judicial pronouncements around this, which to my mind has overreached and written the law on this subject, especially when it comes to, say, Aadhar usage and linkage. It's still judge-made law, which is law today. It's not our representatives debating a motion in parliament, agreeing that this is how we want to regulate it, and then moving forward. That change is going to come in the next 3 to 6 months with the manner in which the PDPA is going to be implemented. We've so far been regulated by a 2000 Act, which said as long as a human person is not touching it, everything is fine. Everyone across the country, across sectors, right? And I'm not just speaking in terms of financial institutions. Everyone's taken benefit of the intermediary exemption. Now that that's going to be called into play, and I want to pick up the deterrent role of the RBI next, right? That I'm coming to you, Mr. Nandakumar. When we look at the RBI's role as a deterrent to ensure that things don't go wrong, do you believe that the audits that the RBI conducts, especially for small to mid NBFCs, and let's now use the RBI terms, which is base layer and middle layer, do you believe that those audits have helped those NBFCs or sort of tailored them for future success? Or have they just been now we are going to spend the next 1 quarter only fixing what we should have done correctly in the last couple of years?
So at the outset, let me congratulate Elets, Dr. Ravi Gupta, for organizing such an event, which is most desirable in the new situation. So whether you like it or not, the changes these have become the order of the day. No, it is not an option. We have to go through that. And one good thing is the regulator is pro-tech, and they want the financial system to adopt technology and in order to compete with the world, to ensure the last mile delivery of services. And what the society, the policy makers intend to do is the financial inclusion. These are required. So now, very in an unprecedented manner, this generative AI tools are being used, particularly in all sectors, particularly by BFSI sectors. So this poses a lot of challenges. There are questions. There are questions around data privacy. The frauds also are happening in between. A couple of days back, media has reported a fraud to the extent of 16,000 plus crores through the payment system. These things are becoming very challenging. From the audit side, large NBFCs are regulated in a tougher manner. Always regulator has in mind about the regulatory harmonization between the banks and non-banks. This has to come. As an NBFC player for a very long time, 2-3 decades, what I have felt in personally, when these tighter regulations are introduced, we used to find it challenging initially, but our experience is after going through the regulation, the benefits are only accruing, and the benefits outweigh the regulatory cost involved. Now, the regulation, as my friends have told this discussion, there is the role of CRO which is emphasized. This Chief Technology Officer and Chief Risk Officer, these are emphasized. In the audit system, what they generally look at is how compliant you are in ensuring that the end users, customers' interest, etc., data privacy, data protection. They look at it. Then how far any player is using an integrated platform, integrated in the sense that one along with the core platform, there will be other vendors supplying their knowledge base to ensure the last mile delivery, etc., etc. So in the credit assessment, credit appraisal, etc. So whether these are working, who are your vendors? What is their capability, and what is the whether these are certified or audited by somebody? These are generally looked at to ensure primarily the data security. You have seen in the recent past using AI, impersonation, etc., and thereby committing fraud like a bank manager, etc., etc., and swindling funds. So the regulator want to ensure that all the stakeholders are benefited with the use of the technology, and the ultimate objective of the society is achieved.
Thank you, sir. I think you summed up the discussion very well, that at the end of the day, if the regulator believes that the customer interest and the larger ecosystem's interest is protected, then they are going to turn a blind eye towards anything that you're doing. But the moment you sort of tread on the toes of either of these two, they will come down with a very, very heavy hand. Now, yesterday when I was given the topic for this panel, and I saw the designations of this esteemed panel, I reached an assumption in my head that the conclusion is going to be that it's a bitter pill to swallow, but you have to swallow it anyway. And for me, what has been the biggest revelation of the last 45 minutes is the acceptance towards adherence to regulatory framework and the underlying purpose behind it being appreciated on the business side. Now, as a lawyer, it is my job to understand it, dissect it, and try and attempt to factor in what was the intent behind it. But for business leaders and the CXOs who have been part of this panel today, to also show that same level of nuanced understanding and appreciation to who I believe is the best regulator in this country, has been phenomenal. If anyone has any closing remarks, happy to sort of take that, or if there are any questions from the crowd. I will take that as a no.
If I may add to that, I'll take the analogy of the headache which I spoke about. Now, we all know eating healthy keeps us, we should eat healthy, we should exercise regularly, we should wake up early, sleep early. We know all these things, right? Yet we don't do it. And we need a doctor to tell us this, we need a physician to tell us this, we need a personal, what you call, trainer to tell us this, right? Treat the regulator just like that, a friend who is telling you to keep you on the right road, right? If you treat the regulator as part of, by design, that you will do the right things, regulator is not to be feared of. Regulator is the fear factor when you know you have done something wrong, right? If you, in letter and spirit and by design, I think he also mentioned about moral principles and ethics. If they are by design part of your system, you don't have to worry about the regulator. What happens is we live quarter by quarter. We have to answer to shareholders. We look at profitability. We don't look at sustainability. Regulator looks at the organization, the business should survive 20, 30, hundreds of years, not quarter to quarter. So that difference, if we are able to do, we don't have to fear the regulator at all.
Thanks. Great session, by the way. Thanks to all of you. Now, as you all said, right, you have been in touch with the regulators, I'm sure, and still worried about what's going to happen next. What are the couple of things that you would suggest to the regulator? I'm sure they listen to you as well. What are the 2-3 things this esteemed forum would suggest to them in terms of business, in terms of technology, in terms of the digital great unknown that is facing us in terms of Gen AI or AI and all that stuff? What would be your recommendations or asks? Thank you.
What I have told the regulator is, not all of us are bad. That's a fact, right? If you treat every one of us as criminals who have to be proven innocent unless otherwise, then that's a problem. So make us part of that discussion, deliberation before a rule comes out, so that we own it up. Otherwise, the problem comes is interpretation. I don't understand what does it mean, what is the letter and spirit. And I think hats off to the regulator. They have had done that, right? So in the last at least 2 years, I have seen the regulator interacting more with us. Whether I'm happy or not, that's a different thing. But interacting more with us than I have seen in the previous 2 decades. So that itself is telling that the regulator wants to learn. It's also because the regulator now realizes that not everything for them is learn and then adopt. There are things happening much faster because of fintech players, ecosystem players who are bringing in new things much faster. And no longer is India a following economy. We don't follow now the West, we don't follow the East or anything. We have our own path. And if that has to happen, the regulator has to take all of us along. Obviously, they will be deciders, but they take us along to get to know things upfront, tell us what is right by principle, deliberate. And if you see, that is why there are more white papers now out, right? They ask for even consumer opinion. Customers can give opinions. You and me, I have no say on, say, Aadhar KYC or no say on a bank. I can give my opinion about it. Now that's a welcome thing. I am part of the solution. So I think that's a welcome one. I would say keep it up.
I'll just add to it what I was saying earlier, with the same thoughts, that the clarity is something I think that would come primarily when the business starts becoming part of their larger discussion. Because what happens is, as much as RBI wants to detail it out, when it comes to implementation, there are a lot more nuisances that starts coming into picture. And for example, I would just take one example. The RBI in the digital lending would say that, I want the interest rates to be established in the letter that you are giving to the customer. But on the practical grounds, when we were talking about the OPEX loan, some of the way our loans were structured, it gets very difficult to follow the letter, the wordings, what RBI is saying. Though we understand the intent, as I said, and we take that approach in the best interest of the organization and the customer, but somewhere that deliberation, somewhere that discussions, I think are unnecessarily, and it spends a lot of time of business to deliberate and come to a larger conclusion.
I think she has covered everything, and he also mentioned at RBI does the deliberations before passing any regulation. They issue draft guidelines, but at times the smaller entity are not able to convey their views. Mostly the deliberation happens with the bigger entities, and their problem may be something different, and the smaller entities have problems something different. The regulation is one size fit for all, and that has to be. So I think sometimes, secondly, when the regulation comes, lot of issues are left for interpretation. I think most of us have found, and when the auditors comes, they are of different degree. The author of the circular doesn't come to audit your branch or office. So they sometimes on small issues report and the penalty is imposed. So such things can be looked into wherever the minor things are there that RBI should ignore. But the regulation has enabled the financial system to become more resilient. And as he mentioned, if you have to survive for 20, 30 years, you should not follow a shortcut. You create a culture in the organization for compliance, culture in the organization for ethics, and things will automatically move.
Thank you, sir. I think there's one last question. And I'm sorry, I do believe there are a few more questions, but we have time for only one more. But the panel is here amongst us after this session as well, and then we can pick up the other questions that you may have.
Hi, this is Manikandan here. I just want to know what is your opinion on self-regulation that RBI had suggested. Do we really need a dictatorship kind of leadership, regulatory authority, or should they allow self-regulating authorities to come up, decide among themselves, and arrive at a consensus? So, what do you feel? Is it a dictator, or should it be more of a helicopter parenting?
You see, in microfinance company, the self-regulation is working. That's why Reserve Bank of India, for Reserve Bank of India, controlling 9,000 and odd NBFCs and banks is a Herculean task. So if in the beginning the self-regulatory bodies are created, probably they will themselves own the regulation because they will discuss together. As I mentioned, the smaller entities are not able to convey their views. So if SROs are created, probably that will be much helpful, lessen the load on RBI, and the regulation can be more user-friendly also. That is what my view is there, if anybody has.
So, in the recent monetary policy statement, RBI Governor himself has said about the framework for SROs. So, I have been working with the SRO in our microfinance subsidiary, and it is working well. Two SROs are there. So, similarly, for all the sectors, it can be in FIDC, which is the Association of NBFCs. The problem is the NBFCs are having different lines of business altogether. So, how a uniform SRO can be? The only solution is this can be classified into three. Then there can be separate SROs. Especially when dealing with a regulator, particularly as the other panelists have mentioned, there is the need of discussion with the regulator when they frame a regulation in all sectors, particularly in technology also. And this SRO can have a technology committee, which can make presentation, which the regulator always welcome that.
So I think just to wrap that question, I think a big insight can be seen from the fact that it is even being considered an option today. If you go back even as early as 10 years, other than IRDA and the Advertising Council, there have been no successes of self-regulation in this country. from the RBI's perspective, they would have not only dismissed the idea, but they would have probably mocked it. Look at where we are today, where the RBI is now looking to encourage it. So it's less regulation, higher enforcement, which I believe is the right mantra for the RBI going forward also.